Hi, this is Hutch with BankingTruths.com, and today we're going to talk about Index Universal Life and specifically the flexibility of any particular policy you set up. And to do so, we're going to use this example of a male, age 44, at Preferred Health. And before some of you start disqualifying yourself saying, you know, I'm a little more chronologically advanced than age 44, or I don't think I'm going to quite qualify for Preferred Health, or possibly both, one advantage you have is the IRS will let you put the same amount of premium. In this case, we're showing $60,000, 5 years, so a total of $300,000. For the same $300,000 bucket, they'll actually allow you to wrap less death benefit around that premium. So conversely, if you're younger and you think you're going to get the absolute best rating, don't think that it's going to be leaps and bounds better than what we're seeing. We're just going to have to put more death benefit around this policy. So the cost structure will be quite similar. It won't be exact, but you'd be surprised how little variance you see when we create these ratios that are allowed by the IRS with the MEC testing limits. So anyway, getting back into the flexibility part, this particular scenario is optimal. It's not flexible. We might be able to fit this into four and a half pay, but just for round numbers, we're spreading it out over 5 years. And you can see we're using an enhanced cash value rider, which actually it does diminish a little bit of the returns over time. But a lot of my clients like to see their full policy value available for loans or withdrawals in case they need the money. So we are using this rider, and there's quite a bit of cash, as you can see, early on and growing even once you stop paying premium. So if we just move on to the next scenario, actually the same scenario but with income. So this is the exact same $60,000 5 times, lower death benefit increasing, and then it levels off as you stop paying premiums. We can see that in this particular case, we can pull $67,000 of income 20 different times. So we put 60,000 in 5 times, and we're going to take 67 and change out 20 times and still leave some death benefit behind, and there's a little tiny bit of cash value there. We're just really bleeding this puppy down, which we don't recommend, but just for the purposes of an apples to apples illustration, we're just using the carrier solves. Now in this particular scenario, you can see the premiums, we're putting in the same 300,000, but year by year, it's not going in quite as quickly. So a lot of times people can put in the max the first year, which is why they're setting it up, because they're flush and they want to get it started. But things happen and life changes. So even though you could feasibly put premium in and then borrow against the policy, especially using this enhanced cash value rider, in this particular case, we're showing some flexibility in that for the next 2 years, you can see that only $10,000 of premium is going in each year. And then things stabilize a little bit, and instead of the 10, you can put in 20, not quite 60, but with this story, say things of the recession is past, real estate values are back up, rents are coming back in, business is picking back up, and now you're able to true up the policy in the 6th and 7th year to fit in the full 300,000. The first thing I want you to notice is your accumulation value and surrender value along the way is still quite robust as a function of how much you've put in. Also, once you get in the full 300,000, although you're not quite break even as soon as you get it in there, as we saw with the 5-year scenario, all that was available for surrender or in their growing interest for you. This does take, you know, you're almost even after the next year, and certainly by the year after that, you're ahead of the game. But notice that it's not that bad. And if we just measure it as a function of income, remember before we could take 67,000 and change, and in this scenario we can't quite take that much because you didn't get as much money working in your policy compounding and earning interest. So you could only take 53,000 20 times to solve down to a very nominal death benefit, but still not too bad, especially when you compare it to other asset classes with a similar risk profile, such as bank accounts and CDs, or high grade bonds of the same quality as the carrier that issues this policy.